Morning, everybody. Appreciate you using the phone booth this morning, Michelle. Way to go. We'll give it a couple minutes. I think I'll start in about 2 minutes. Well, good to see you all, or see a few of you, and see a lot of your names. Appreciate you guys joining this morning. I'm going to jump in and hit on a couple just real quick update things before diving into some thrilling numbers analysis, more on the same topic, but I think y'all will find this relevant. You'll see why. The two quick updates. So just following up on conversations we've been having for the last week or so, many of you have signed up to go with us Friday morning with downtown Indianapolis. So we're looking forward to that. So from 9 to 11:30, a group of 25 of us will be joining, I think 75 other people, assuming they filled it, to clean up a section of downtown Friday morning. Rosie, do we know yet where we're supposed to meet Friday?
Yep. So everyone come to the north point of Monument Circle. We'll all be meeting there, and wear your plaid shirts if you can.
Cool. Looking forward to that Friday morning. Second quick update, the fundraising effort for Martin Luther King Center in Butler, Tarkington. That's going well. Many of you have contributed. Many of you have shared it with your networks. Thank you so much for that. We are, last I looked, I think we had just passed $2,000. Maybe we're a little bit higher than that now. And one option, in case you missed it on the Facebook page, if you would want to participate in that via transactions, just to kind of make it administratively easier, shoot a message to Emily or myself or Ashley and just say, hey, out of the next however many transactions or for this period of time, I'd like for the brokerage to withhold $25 a transaction. We will, as a brokerage, then match that out of our revenue. So you would just see it as a reduction in commission, and then we would donate that money on your behalf to the MLK Center. So you could just shoot us a message to let us know to do that. So thanks for partnering. Natalie, yeah, I think let's hit on this. Natalie's asked a question there in the chat. I'm going to hit on that before putting y'all to sleep with some data. So if we go to the data first, Natalie, no one's going to be paying attention when we come back to this. Natalie has asked, can we discuss if sellers find their own buyer but want our help, what forms we need to do when, especially if we don't want it on the BLC, it closes and buyer agent is at another brokerage. Natalie, just to clarify, you don't want it on the BLC during the pending period, or you do not want it on the BLC ever? So is there a preference for it to never go into the BLC? During the pending period? So your intent there would be to put it into the BLC like as a closed transaction? Yep. Yeah, great. So when a seller finds their own buyer, I know this maybe is a little bit counterintuitive, but you do still need to have, I think the best way to do this is still a listing contract between you and the seller. So it's an agreement to compensate you for representing them as seller. And if the buyer has an agent, which it sounds like in your deal, the buyer has another agent at another brokerage, then you don't have to do a limited agency form. But before you start working for them, I would do a listing contract, and then I would, oh boy, the clear cooperation does actually make this complicated because you can't do an office exclusive because the other agent is at another company. I think the right answer to this, and Natalie, I want to think about if there's another route. I think the right answer would be to put it in the BLC as pending. But you're saying we don't want it in the BLC as pending? That's a really good question. I don't think I could think of some reasons why you wouldn't want it in the BLC as pending. I think I get that. What vehicle would there be right now when the agent is at another brokerage for you to have the right to represent the seller and get compensation? Yeah, you definitely need to have a listing contract. What I'm working through my mind is I don't know. I don't know the answer to what would you need in addition to a listing contract to avoid needing to put that property into the BLC as pending. I think in most cases, you just do a listing contract and it's listed and pended right away. So let me think on that and get back to you. Sorry that I don't know. I might connect with you individually to kind of figure out what's the specific motivation of it not being in the BLC as pending. And there might be a good solution to that. Yeah. Gosh, y'all, we're not even 10 minutes into the call and Natalie's already stumped me. Thanks, Natalie. Okay, so I'm going to share some stuff today that, again, it's maybe numbers heavy, but I want to give you the context of why I think this is relevant. And I bet some of you are getting similar questions to what I'm getting from maybe from other agents, but for sure from consumers. I was talking to yesterday, I had a conversation with a lender and with a retirement financial advisor. And they were both trying to understand how the real estate market was so hot. Like the combination of high unemployment numbers and this kind of pending recession conversation with record high prices in real estate and like really low days on market, and that by most ways that we would use the term hot real estate market, like this fits, right? It's a very hot real estate market. And so they were just getting my opinion on why do you think both the like looming recession and high unemployment and that are true at the same time. And obviously it's a complex question. There's all these factors to this. But I think really what this comes down to, my opinion, there's two key factors to this. It's inventory and interest rates. And so as an agent, again, like we've talked about, I don't think it's your job to be an expert economist on inventory or interest rates. Like, that's not what you're trained to do. But I think it is good to just have a general understanding of why does the market work in a certain way sometimes, particularly when it maybe is counterintuitive, right? So if a lot of people have lost their job, record numbers, but yet the housing market is booming, how does that happen? So I'm not an expert here, but this is something that I try to understand as much as I can. And so I'm going to convey two things. One of them is from an article that I sent. You got it in your inbox last night. No worries if you haven't had a chance to take a look at that. And fair warning, this article is the definition of TLDR. Like, you will drown in the numbers because it's super nerdy. There's like complex math formulas in it. But I want to highlight one thing from that article that I think is good for us as realtors to understand, and it has to do with inventory. So thanks, Rosie. I figured I'm one of the oldest people on the call, so if I know what TLDR means, most of the rest of you do. Ouch. Ouch. Really digs. Yeah.
I'm sorry, I couldn't help myself.
Yeah, I could tell. Yep. It's not untrue, but it still hurts. So so back to inventory. The thing I think is a theme out there nationwide is, if you haven't heard this, nationwide, we don't have enough houses for sale. Like, that is something that pretty much anyone doing analysis on this, realtors, association of realtors, builders, mortgage companies, economists, they all agree that whenever you attempt to measure how many likely buyers are out there versus how many homes for sale are there, we have an inventory problem. This article from Freddie Mac estimates the inventory shortage to be something like 2.5 million units. And so that's kind of conceded right now. Everybody agrees that we're short on inventory. What this article does that I think is pretty interesting is it tries to dive into this idea that, okay, as a country, maybe we're 2.5 million units short, but we're in an industry that inventory doesn't transfer easily from one geography to another. So an example of what I mean by that, I was talking with this about my team yesterday, and I used this example that oil. There are times where we might have an oil shortage, but if we're short on oil in the country, if Ohio happens to have a surplus of oil and Indiana has a shortage of oil, what happens? The oil moves, right? Like through some transaction, Indiana, essentially the marketplace here, would buy the oil from where there is a surplus. So that's a product that can move easily across geographic lines. And so the shortage really does tend to be a national shortage or a surplus. Well, real estate doesn't really work like that. So if Rob is working with a buyer who's trying to find a product in Indianapolis, Rob has a buyer trying to find a $250,000 3-bed, 2.5-bath home in good condition. That's a nightmare right now. Fair? Well, it doesn't really help that buyer if Cleveland, Ohio has a surplus of 3-bed, 2.5-bath homes, right? Odds are that buyer's not going to make a decision to move to Cleveland because they could buy a house there. They're going to go to their next best option in Indianapolis. And so what this article from Freddie Mac does, which I thought was really interesting, is it tried to dive into state by state surplus and shortage to say, okay, if 2.5 million is the shortage nationally, how does that look around the country? And so I'm going to share my screen. Once Rosie gives me permission to share my screen. There we go. Okay. So you all can see that map. And to decode this map a little bit for you, a positive number on a state indicates that that state has a shortage of houses, okay? So a positive number means there are more buyers than sellers at the moment. And obviously this is kind of meshing a lot of variables like price points, et cetera. The higher the positive number, the more there is an inventory problem on the shortage side. So you look at, probably not surprisingly, Oregon and California have some pretty big supply issues right now. They're way short on inventory. So one of the things this article mentions is those states right now are really trying to loosen up their zoning restrictions. So they're basically trying to make it easier to build houses because they see this big problem. Obviously, Florida, Colorado, Minnesota also have some big shortages. What's one pattern that you notice just as a quick glance? The map, it almost kind of looks like election night map, right? Like there is a color pattern that the more towards the middle of the country a state is, the less likely that state is to have an inventory shortage. You see that? So right now the supply is low, generally speaking, on the coasts, including Florida and Texas. If you draw a triangle, sorry, if I cursor over it makes it harder to see, but I think you could still see this. If you just draw a triangle from Montana, so get Montana, Wyoming, the Dakotas, Nebraska, Kansas, Oklahoma, Arkansas, Mississippi, Alabama, Georgia, South Carolina, Tennessee, Kentucky, West Virginia, Pennsylvania, Ohio. You see the triangle I'm drawing? Okay. I'm going to get off of that so you can see it. It's a fairly large section of the country that in terms of real estate would have the most in common with central Indiana, right? There's not too many high-priced markets there. The cities, Kansas City, Omaha, St. Louis, they all have pretty similar markets to ours. Look at the numbers in that triangle. You notice that we are the second highest positive number. Do you see that? Minnesota being the only state in that triangle that has a higher positive number than Indiana. So you have to get outside that triangle to get to the East Coast or Florida or Texas or Colorado to get to a higher number than Indiana. So what that means is that in what I would call the Midwest, in the Midwest central part of the country, Indiana has the shortest supply other than Minnesota. And that's because we have a growing population. So Illinois, for example, has a shrinking population. That's a part of the reason they don't have a housing shortage. Their population is shrinking. Love the fact that we gain population from Illinois to Indiana every day. Thanks, Chamber of Commerce. But Indiana has a growing population. We have a good job market. And we have a housing shortage because of that. If you add in, so looking at that triangle, saying good job market, growing population, housing shortage, if you add into that Indianapolis is still the second most affordable of the 30 largest markets in the country. So of the 30 biggest, Memphis, Tennessee is more affordable than Indianapolis, but that's it. Just put your guessing hat on and say, what does that predict to happen in the central Indiana real estate market over the next decade? I'm going to stop sharing my screen for a moment and go back to where I can see you all. You feel free to comment here on the chat or to unmute yourself. So if in the chunk of the country that's most like Indiana, only Minnesota has a bigger shortage of houses, and we have a growing population and a good job market, and we're really low priced right now, currently. Yeah, Ryan nailed it. Ryan's prediction is kaboom. Ryan, what do you mean by that? I'm assuming that's Ryan Boyd that's saying that.
No, it's Rominger, actually.
Oh, there you go, Ryan.
Had to unmute myself. Yeah, that's, I think the factors that you just described, Mark, are contributing to and you couple that with where technology has brought us over the past 2 decades and how easy it is to, for a investor from any part of the country to purchase property in Indianapolis. I think those factors combine to, you can go on a dozen different real estate blogs and people are talking about how Indianapolis is the market to own property in right now. And so a lot of people are trying, a lot of people are after it. And I know as someone who tries to work with a lot of investors, there are certainly challenges that go along with that, but there's no shortage of people looking to purchase properties, investors and owner occupants alike.
Yeah, the affordability piece is, I think, becoming increasingly attractive. The technology, I actually had coffee this morning with someone that works in the tech space in Indianapolis, and he made an interesting comment about COVID. He said, like, the tech space already was kind of embracing this, but he's seeing San Francisco-based companies look a lot harder right now at relocating workforce to markets like Indianapolis. Kind of coming into this realization of, like, you don't have to live in San Francisco to work for us, which is interesting. Yeah, all this points to, this is why our market feels hot, even though some larger conditions would say, but should it be hot right now? Well, it's because we just don't have enough houses for sale to meet the demand. And it appears that I'm gonna call it a problem. I think you could debate whether it's a good thing or bad thing, but it appears the problem is actually getting worse. That our supply, this low supply, especially of median price houses, that problem's not going to go away. I think looking at the conditions would say it's probably going to get worse over the next several years, which means what happens to prices? Yep. Yeah, Trisha just said they're going up. And obviously nobody can predict the future, but I think for those that have lived in Indianapolis over the last decade, most of us have this sense that Indianapolis went through this price increase over the last decade that was pretty significant. And in some senses we did, but I don't think the big thing has happened yet. Like, these are the indicators that led to what's happened in some cities like Denver would be a good example, where Denver has really gone through their last 10, 20 years has been a radical price shift. And I'm not, guys, this isn't like all good news. I'm speaking of this just as reality and things to be aware of. Like, what does this low supply of houses mean and what's likely to happen because of this? I think there could be an affordability problem in Indianapolis. I don't think Indianapolis as a market has an affordability problem right now. It has an inventory problem right now. But if you have an inventory problem for long enough, you end up with an affordability problem. Does that make sense? The second piece of information I want to share, and then I want to try to leave room for questions. I'm going to share my screen again. And okay, can you all see this? Even the font on this makes it looks like it's old school computer generated. So this is a summary of weekly average interest rates. So you look where I'm highlighted right here is January 5th of 1990, going back 30 years ago. 30-year fixed rate mortgage average on January of 1990 was 9.83. Okay. We're going to do a little visual exercise here, and I'm going to scroll down for 30 years. Watch what happens to this column, column B, starting in January of 1990. Okay? It's a fun exercise. Okay, so there was a decade where you saw rates get down into the sixes a little bit, but not a ton of change. Rates basically going from the nines to the eights. This is the 2000s. Okay, what happens at the end of the 2000s? What significant real estate event happened in 2007 and 2008 where you saw really quickly rates kind of were hovering in that like 8, maybe 7, kind of down into the sixes, which in the mid 2000s was viewed to be like incredibly low. The recession hits, boom, rates go into the 4s and 5s. Now the last decade. We're at 3 3/4 at the end of 2019, and then in 2020, this is weekly of 2020. We're sitting as of last week at 3.2. Okay. I like the visual of that because I think it's a good illustration about purchasing power. And are low interest rates good news? I mean, generally speaking, yeah, we view them as good news, right? Like high is bad, low is good. That's how we look at that. But for a long time, interest rates basically hovered between 7 and 10. The recession changed that. But now we're more than a decade into a good real estate market. And now we view, many of you have probably seen some mortgage originators on their Facebook pages saying, because you're all friends with the same ones I am, if your mortgage interest rate is any higher than 4, you need to call me to refi. Like, that's insane. It's true. They're right. That's insane. Historically, where we are now, that low of interest rate gives so much purchasing power. So from a 10% interest rate to a 3% interest rate, that essentially doubles the purchasing power of an average buyer. In terms of like given income, given real estate market, they're going to buy about twice the house. So think about like what house that changes them from A to B, with nothing else changing. Hardly anybody pays cash, especially if interest rates are in the threes. Almost everybody's going to borrow money. My dad, this is like typical, like I remember when my dad talks about buying his first house at 19% interest, and that kind of the conventional wisdom was it wasn't smart to buy a house if you couldn't put 50% down. So you think about what that did to buying power. Most people were saying you had to have 50% down and you had to pay 19% to borrow the money. Well, that eases a supply problem because you're keeping a lot of people out of the market. But right now, if interest rates stay where they are, and it appears they're going to, it's bringing people into the market, which is a good thing. But it's those two things. Supply is low, and then that is being compounded by super low interest rates, which keeps people in the marketplace. You don't have to be an expert on interest rates. You don't have to be an expert on supply. I think it is worth, just kind of generally speaking, as people ask, knowing why the market is hot. But then also, I think in terms of Indianapolis, just having a sense of what's this next decade going to be like. And my opinion is that 10 years from now, we're going to be saying, can you remember when our median price in central Indiana was under $200,000? Like by 2030, I think that's going to be very difficult to recall. I think our median will be nowhere close to $190,000 like it is now. And again, I'm not celebrating that or dreading that. I think that's a different conversation. But I think it's important that we understand the things that are happening that could lead to that. Tons of stuff. I'm just going to assume that those who I can't see your face, you're probably asleep by now. But for those that are still in, what does this make you think? Does it excite you? Does it concern you? What questions does it cause? Do you feel like it's relevant? Like, feel free to say, like, Mark, I don't feel like this is relevant. You got to convince me that this is relevant to my day to day, where I'm like just trying to help the buyer find a house right now. Yeah, Tricia, it's a great question. Maybe another way to ask this question is, will incomes in Indy continue to rise as the cost of housing goes up? I think that's one of the reasons this isn't all just like good news. I don't know. Joe, Denver in 2012. I think that's Denver, Portland, Nashville, Austin, Texas, some cities that have some things in common with Indianapolis now have a much lower percentage of their population that can buy a house. Indianapolis has a fairly high percentage of our population that can own a home. I don't know if that's going to be true 10 years from now. So Tricia, I didn't answer your question, but I think it's because I don't know the answer.
When that percentage shifts, if it, is it shifted in Denver and shifted in other places, does that mean that we look at, that we have a higher percentage of investor-owned properties? Like, do we change the rate of home ownership between renter and homeowner? What does that mean in those cities that have gone through that transition?
Yeah, some of it is density, but I think that's right. You're going to have more rental, like that a percentage of rental would go up in the region.
So less home ownership in general, by home owner occupier. Yeah.
And we could be a long way from that. We're just looking at like kind of forecasting, but it does seem like that's what's going to happen to me. Yeah, Ryan, I think makes a good point there. Ryan says, tell normal buyers to buy while they can and ride the wave. Um, I agree with that. I think, and Ryan, I'm not saying your comment does this. I would exercise some caution in the like, don't go and say, hey, trust me, real estate's going to be super expensive in Indianapolis in 10 years. Well, you don't know that. Nobody knows that. If I knew that, I would be doing everything I could right now to leverage every dollar I could and just buy. So I don't know that. But what I think is helpful to say to people, share some of this information. We have a short supply right now. It's super affordable in Indianapolis. There's reason to think that prices are actually going to go up quite a bit in the next 10 years. People that bought 10 years ago are glad they did. So I think there's good indicators. So you can't offer that guarantee, but talk about what's likely going to happen. And then I think you can share, I share my own personal experience. I've had some people say they think we were in a bubble last year, like prices were too high in Indianapolis. And I'd say you might be right, but to whatever degree I know what I'm talking about or don't know what I'm talking about, I am buying as much real estate as I reasonably can, personally, right now. And so I think sometimes it's just helpful to tell them, here's my analysis and what I'm doing. That doesn't mean I'm right, but I think it helps them understand like, oh, Ryan isn't just trying to talk me into buying a house because he wants the sale. He really does think a big price shift is coming. Ryan, it's a good comment. I think the inventory problem and income inequality, they're actually somewhat connected to each other, and they're both massive issues. That's why I'm trying to be real clear on I'm not talking good or bad. I'm really just trying to talk in the realm of what's happening. I've chatted with Joe about this kind of briefly, but in the past, Joe, what years did you live in Denver? Can you remind me?
Yeah, can you hear me?
Yeah.
So I was in Denver 2005 to 2018.
Yeah, well, what happened in Denver during that 13-year period?
Yeah, it was absolutely insane, and Indianapolis completely reminds me of exactly what happened in Denver, and it's really interesting to be part of two markets like this. First of all, amazing information. I'm really glad I jumped on this call. This is invaluable information for everybody that's a part of this, and really great info to pass on to your buyers. So great work on this presentation. So in 2005, Denver was coming out of a bit of a slump. And it wasn't a terrible market, but it wasn't a great market. And then a lot of momentum built up with population growth, business growth, and the housing followed, of course, because housing follows population growth and economic growth. You build more houses or more houses sell. And then so from 2005 to 2008, you had this boom period. 2008, the recession hits, the market tanks. I mean, 25, 30% in 2008, 2009. That spurred a lot of investor buying, a lot of foreclosures, and a depressed market. And then in 2011, 2012, 2013, things just blew up. And now you have those price points that dropped 20, 25%. They went up 20, 25%, 30%, 35%. So it was this drastic shift. Now, I think, in my opinion, I think Indianapolis is a little bit more insulated from those dramatic swings like that. However, with the population growth, with the statistics that you pointed out, which are just black and white, low inventory, population growth, business growth, economic growth, migration into the state for the first time that I can remember even growing up here. I think that is a great opportunity for real estate agents to do really well if they hustle, and buyers still have a great opportunity. I mean, interest rates in the 3%, people can still buy properties. Your buyers will still be able to buy properties. I feel like people need to go in letting their buyers know the expectation needs to be to make a strong offer fast if they like a property with low contingency, and follow up with those sellers, man, and let them write a letter. Have your buyers write a letter stating how much they love the place, why they want it. I also do the just the black and white numbers on investment properties. It's a great time for a buy and hold investor or a redevelopment investor. So I think the market for the next several years creates a lot of opportunity on a lot of different aspects, both investor real estate and that buyer who can get in right now and hold on for 10 years. And then they look back and they're like, I can't believe I got this house for $250,000.
It's funny that you just said that about 250,000. This was not staged, I promise. As Joe was sharing, I recall a conversation with a lender. This was the last time I sold my personal residence was 4 years ago, spring of 2016, small Fall Creek Place house. I listed it on a Friday. By Sunday evening, I had 8 offers over list price. And guys, I can guarantee you there was nothing special about my house. It ended up selling right at about that price point. And I kind of knew it would underappraise. I had tried to work that out with the buyer in advance. It did underappraise. And the lender said, like, here's the problem. We can't lend into a bubble. We think the buyer's going to regret buying this house. And hey, hindsight's 2020. That house is now worth significantly more than the buyer paid.
Yeah.
Like that. And granted, 4 years of hindsight, same comment I made to Ryan. I think you have to be really careful about offering those sorts of guarantees. If you're representing a buyer in a very competitive situation, you don't want to say something like, hey, in 4 years, this is all going to seem silly because the house is going to have appreciated a bunch in value. You can't offer that guarantee, but that is what all this indicates is going to happen. And the feeling we have right now is very similar to the feeling we had in 2016. That's thanks for sharing that off the cuff, Joe. It's great. And yeah, the cities have differences, but there is a lot, I think, to be learned. I honestly think as an industry, and this gets at, Stephen, I really appreciate your comment earlier. Stephen was saying in response to my question about like, what do we think happens? Stephen said, hopefully a giant influx of African-American buyers to gain generational wealth. I think that, and maybe Trisha's question, get really well at this. Is Indianapolis going to lose one of its, I think, most valuable assets, which is accessibility? Like we're not perfectly accessible now. So I'm fully aware of that. There are a lot of people in our community that can't access the same value that a lot of our population can. But in comparison to other parts of the country, that's one of the assets that Indianapolis has, is it is generally accessible. And I think that's a legit concern that could be like slipping away. It's not yet, but all this indicates that it very well could. Massive conversation. Rosie's getting at the, like, what do you do to fix that with her question? Not that I meant to skirt that conversation, but we're definitely not going to have time to tackle that. But I think as an industry, it's a legitimate question and one that Indianapolis has to be asking. Our geography helps. I will say that. The fact that we don't have geographic constraints in any direction gives us a bit of an option to grow more like balanced, but y'all, it's 11:47, so I'm 2 minutes over the goal. I know it's just like numbers after numbers after numbers. I would encourage you, try to pour over this stuff a little bit at least. Read the article, see what you can pick up from it. Track the interest rates, just see what you can gather. And I would always be open. If you're like, hey, I think I get this, but I feel like I want to grasp it more, give me a call, shoot me a text, let me know. I'm happy to talk through it. I'm not an expert, but I do spend a decent amount of time trying to familiarize myself with this, so I'd at least be up for the conversation if it's helpful. Last thing, thank you, Rosie, for this reminder. Jess Martin, our fearless leader, is on vacation with her family in Michigan, which is great. I'm super excited for her for doing that. If you have any painful transaction issues in the next 5 days, send them my way. I look forward to them. I was going to say I miss them. I really don't. If I'm honest, I don't miss them. I'm very glad Jess is doing them and doing a better job than I ever did with them. But for the next 5 days, you're stuck with me. So if you can remember that, shoot them my way. Hopefully you get an out of office from Jess if you do send them to her, and that can be your reminder to say, oh yeah, Jess, great, I'm going to send it to Mark. Sorry for the fact that I'm going to help blow up the deal that Jess would have saved in advance. Tricia, yeah, you can also send those to me. I think Jess is just still signing them, honestly, which is fine. But I don't think she's as concerned about the signatures on releases or listing contracts as much as the kind of time intense if you end up in a challenging deal. Send that my way. Yeah. Okay. Everybody, thanks for joining. We'll see a lot of you Friday morning. Look forward to chatting soon, and feel free to take me up on the offer if I can ever have a conversation with you about this stuff. Thanks, everybody.